Good afternoon. Hello, everyone, and apologies for the delay in starting. We've had some technical issues. Hopefully, you can all now hear us. We'd better get cracking. So welcome to the online webinar for how to cut electrification risks and costs, the Residual Value Guarantee Blueprint. My name is Tom Park from the Green Finance Institute, where we've been working on solutions to help unlock finance for net zero, including the Residual Value Guarantee Blueprint, which is a mechanism designed to unlock finance for zero emission trucking that we've created alongside CalStart and supported by a task force of financial institutions, OEMs, fleet operators, and other key stakeholders. Residual value guarantees can help to de-risk investment costs, accelerate the uptake of zero emission trucks, and maximize the impact of public funding. And this webinar is aimed at fleet operators, OEMs, and public finance institutions that are interested in how they can reduce their decarbonisation costs, reduce the risk of investment, and maximize the use of public spending. What we want to do with this session is raise awareness of residual value guarantees through and discuss the Residual Value Guarantee Blueprint, which is officially published today. We've also got an exciting panel of experts from Volvo Group, the FDS and DLL, where we will discuss the potential impact of residual value guarantees for key stakeholders. I'll quickly run through the agenda. We will have a very brief scene-setting session from Climate Group, followed by a presentation on the blueprint from myself, Tom Park from the Green Finance Institute, and Ricardo from CalStart, then followed by a panel discussion, and then a call to action at the end with concluding comments from the European Clean Trucking Alliance. We're really pleased to be partnering with the Climate Group and the European Clean Trucking Alliance in delivering this webinar, who have been working closely with their members over the last few years to help them with their decarbonisation efforts. And we're really keen for this webinar to be the start of a collaboration where the GFI and CalStart look to deploy and support governments with the expansion of residual value guarantee schemes in multiple jurisdictions. I'll hand over now to Sam at Climate Group.
Great, thanks, Tom. And I'll try and be as brief as I can, given the issues. Just to share my screen now. So yeah, thank you very much, Tom, for the introduction, and it's great to be here on behalf of Climate Group and our EV100 campaign. I just want to give a very brief scene setting here, just to give you an update on how the EV100 initiative is going on the heavy duty and medium duty side, and also to provide a sort of update on how we see the market developing. So just very quickly, for those of you who don't know who Climate Group and EV100, we are an international NGO with headquarters in London, but operating in several continents around the world. And we focus on building business and government networks to drive climate action across the highest emitting sectors of the global economy. So EV100 is one of our big campaigns. And what this involves is bringing big corporates together. That includes some of the biggest shippers in the world, like Geopost, IKEA, Maersk, right through to other large corporates in the healthcare sector and the energy sector. And what we get them to do is to commit to electrifying their vehicle fleets to ambitious deadlines across different vehicle segments and markets around the world. And what we aim to do through this is to obviously speed up the shift to EVs, drive up demand, and in so doing, bring down prices. And we also work with them to drive policy change in key markets around the world, making EVs rapidly more affordable and accessible for everyone. In terms of our impact, since we were launched in 2017, we've expanded to over 120 global members. We have seen 3 million EVs committed by these companies, 701,000 of which have already been deployed, alongside 30,000 charging infrastructure facilities for their customers and their employees. Now, the key point here, and probably most relevant for this webinar, is that despite all this progress, the kind of e-truck sector we are seeing is moving a little bit slower. Obviously, we've seen some real progress here, but of the 701,000 vehicles deployed by our members, 400 of those are e-trucks so far, though we have over 20,000 of those committed. So we've kind of reflected this in our commitment criteria. So you can see here that for trucks, the sort of horizon for decarbonisation is 2035 and 2040, and we've revised those this year to match some of the market realities that we're seeing. We've also adjusted this from a overall stock target to a flow target to reflect some of the difficulties in this space. So yeah, what are those market realities? And very briefly before I hand over to Tom and Ricardo, I just wanted to highlight some of the statistics that we're seeing on e-trucks, and this is from data recently released by Bloomberg and Smart Freight Center. Now we've seen obviously great progress. So 89,000 zero emission trucks sold in the first half of this year. That's up 136% from last year in the same period. But we can see this is actually quite an uneven transition. So China accounted for over 90% of those sales. Europe definitely has done well so far. We've seen sales up 50%, but this is very much focused on some of the leading markets. So the Netherlands, for example, I think it's 1 in 5 trucks sold in Europe from there, and they've got a sort of sales share of around 78%, which is obviously excellent, but we need to see that spread a bit more widely across the continent. We're also seeing lots of new models come onto the market. So around 3,000 models now available in the major markets. However, if we look globally, sales are pretty patchy, and with the recent policy changes, we've seen sales plummet in the US. So what's key here is that really policy is what's driving a lot of these outcomes. Incentives, infrastructure availability, vehicle standards, these all matter. But we're still at a very low base, so we need to see a lot more progress on the policy front if we're going to see zero emission trucks really take off in a widespread sense. And that's why it's great to be here today. I just want to highlight very briefly some of the barriers that we're seeing, and these are the things that we'll need to overcome in order to really unlock progress in this next stage of the transition. And barrier one in particular that we found in our annual report, which was published earlier this year, a lot of our members cite the high upfront capital cost of trucks as being the kind of main barrier to the transition, and that is outweighing some of the long-term cost savings, for example, on fuel. So what we need really is attractive financing and leasing arrangements. This is something which our members have been very interested in for a while, to improve that business case. And I think the residual value issue is obviously a big one for leasing companies, and in order for big fleets to find attractive leasing rates, I think understanding how we can tackle that residual value issue is going to be really key. So that's why I think it's great to be here, and I will now hand over to Tom and Ricardo, who are going to talk you through, I think, in a bit more detail about how we make that happen.
Thanks very much, Sam. I think that sets up perfectly why it is that CalSTART and the GFI have been looking at this problem. The fact that there clearly is demand in certain areas for this new technology, but there are still issues with accelerating the transition as quickly as we need to. So we will now dive into a presentation of the Residual Value Guarantee Blueprint itself. Very quickly on the Green Finance Institute, we are focused on unlocking finance for net zero at pace and scale. We've been doing this across multiple jurisdictions for the last 6 years, and we tend to work sectorally. So this work falls within our road transport work, where we've been looking at zero emission trucks and designing new solutions that can help to unlock capital at pace and scale from the private sector for the last couple of years. I'll hand over to CalSTART now to give context around why we've partnered together and to kick off the presentation.
Thank you very much, Tom. Hi, my name is Ricardo Garcia. I am program manager for CalStart's Drive to Zero team. For those who don't know us, CalStart is a US-based nonprofit organization with 34 years of experience working in bringing down emissions from the transportation sector. Internationally, we co-lead the Global Memorandum of Understanding on Zero-Emission Medium and Heavy-Duty Vehicles, which has been signed by 40 signatory countries and supported by over 270 endorsers globally. This initiative sets the target of reaching 100% new sales of trucks and buses being zero emission by 2040, which is also aligned with the targets that Climate Group shared before. So I'm delighted to share with you some of the takeaways from the work we've been doing with GFI. Many here on the call have actually helped us put this research together and have informed this research with your input. So thank you to all who have made this product possible. Why we decided to focus on residual values. So from multiple conversations that we've had with financiers, we found that residual values, when they are very low, tend to result in higher periodic payments for fleets, particularly when we're looking at leasing products. What you're seeing in the chart here is on the left side, what the pricing would typically look with a low residual value. The column on the left would be your delivery price for the vehicle. Your column utmost right would be your residual value. So the interim payments are based on the difference between those two. If the residual value is small, those payments will be bigger for fleets. On the other side, what you're seeing on the chart on the right, if the residual value is higher, then those periodic payments can be lower. And this is why we are so interested in looking at the potential of this type of structures to actually bring down the cost of leasing products. So how would a residual value guarantee work? The residual value guarantee would reduce potential losses from financial institutions in the case that the resale value of the vehicle ended up being lower than initially expected. By doing so, it allows the leasing providers to offer more affordable products for the fleets, which makes the transition less expensive and more feasible for everyone. What you're seeing here is, again, two scenarios, one without a guarantee and one with the guarantee. In the without the guarantee scenario, what you are seeing in blue is the likelihood of the resale value of the truck. Now, it is very likely that you'll get a small amount, a bit less likely that you will get a larger amount, and eventually it becomes virtually impossible that you will get a significant amount after a long period of time. When this happens, most financial institutions need to make sure that they are not taking on losses because that would hurt their business model. So what we are seeing is that the monthly lease payments tend to be higher because they need to protect themselves from certain residual value risk. With a residual value guarantee program, what you're seeing on the right side is that you have a mitigation in terms of how big those residual value losses could be. And this allows financial institutions to count that they will certainly get at least a certain percentage of residual value, which makes the calculation of the monthly payments easier and lower. So this is how the residual value would be operationalized and how it would translate into lower payments for the end users. And now I will pass it back to Tom to explain a bit of the inner workings of this product.
Thanks, Ricardo. So the way that this product would work is it would be designed for primarily a specific group of approved leasing or finance providers. So once an originator has been approved to the scheme, they can then submit new vehicles for coverage and through that they will obviously then go through a residual value setting process. Once this will then result in them periodically every quarter declaring the volume of leases that they are putting through the scheme, and the guarantee manager in the case of a funded scheme, which for everybody's benefit is basically a scheme where actual money is being set into a real fund. That scheme will be put in a pool that then can be drawn down at a future date. The end client then covers the loan or lease payments and carries out the lease. The originator is the one responsible for paying the annual coverage fee, which effectively will function like an insurance product. So that will be paid, that will typically be paid annually, and that will also be set into the same pool as the funds from the guarantee manager. Then at the end of the lease period, when the vehicle is sold to a third party, that vehicle valuation is checked against the fair market value. If it's lower than that, then the lessor will receive a payment. If it's higher, then the lessor will actually be required to pay back into the pool. And what this does is it allows for the recycling of funds. It also allows guarantee managers to potentially benefit from upside, which we see as being really important, because at the moment, although residual values for electric trucks have been improving over time, as we'll hopefully hear from the experts in the panel session next, they could still be higher, particularly if we're going to get them to the same levels as diesel vehicles. Could we go to the next slide, please, Ricardo? And so the benefit of a scheme operating like this, we have done modelling to look at what could be achieved with a 10 million pot of money dedicated to a residual value guarantee. And what we've done in the scheme, and as detailed in the blueprint, is looked at different financial structures that can help to incentivize an increase in residual value. And what this does is this has benefits both for leasing providers and for guarantee providers. So we've calculated a 12% saving if you are a fleet leasing an electric vehicle under the scheme versus if you were leasing it outside of the scheme, due to the improvements that I mentioned in residual value. And then equally, it will result in potential cost savings for guarantee managers due to the fact that a guarantee isn't necessarily expected to always be called upon compared to if the money was allocated as a grant. And there are also other benefits, for example, the fact that you can generate upside or receive fees for access to the scheme. And what this means is ultimately roughly 2 times more trucks that can be deployed through money being used as a guarantee rather than as a grant.
Finally, the last section of the blueprint offers an 8-step implementation roadmap on how to go from the idea of a residual value guarantee to actual implementation. And this is partly based on the process that we follow to actually do this initial blueprint. One of the first things was that we needed to create a task force with financial institutions that have hands-on expertise in a specific market. And then all the process is based on that expertise. Whenever we're looking at a specific implementation in a different country, it's very important that the content in the blueprint is adopted to that specific market. So this is the way we're seeing it, the first step in what will become a series of different efforts focused on implementation.
Thank you very much, Ricardo. So if you would like to get involved, then you can download the residual value guarantee blueprint now using the QR code below. We are keen to hear from governments who are interested in residual value guarantee implementation, and any companies, fleet operators, financiers, lessors that could potentially be playing a role in shaping the implementation of guarantee programs in Europe by joining a task force dedicated to your particular country or jurisdiction. So please do reach out. Our contact details and the slides will be shared after this meeting. But for now, we will press on into the panel discussion, where we will be hearing from key experts from finance, manufacturers, and fleet operator industries. I will briefly ask each panelist to introduce themselves, and then we'll enter into the main discussion, where we'll ask a series of questions around how a guarantee could benefit each of the different stakeholders. And then at the end, there'll be time for a short Q&A from the audience. So without further ado, Amy, if you wouldn't mind going first, please can you briefly introduce yourself and your company and your role in deployment of electric trucks?
Yes, sure. Hi, everyone. It's great to join the webinar today. So my name's Amy Stokes. I am head of electromobility for Volvo Trucks. So Volvo Trucks, the largest heavy truck manufacturer in Europe, with a clear strategy built around sustainability and decarbonisation. My role is to support the here and now and how we achieve electric sales today, but also then looking at the long term and strategically how we can grow the proportion of electric and indeed other zero emission technologies as they come, so that we can achieve our long-term decarbonisation ambitions. So I support the UK and Ireland market company.
Thanks, Amy. Ladija, I'll go to you next.
Hey, yes. Hello, everyone. I'm Lydia Peters from DFDS, leading the pro decarbonization team at DFDS. And what that actually means is that we are making sure with my team that all the initiatives and projects that we are driving in operations are aligned with our pathways towards net zero. And when I say with our, then I mean DFDS, ferry and logistics operator in Europe, UK, Ireland, and the Mediterranean.
Thanks, Lydia. And Roman, over to you.
Yeah, hi everyone. Nice to meet you all. I'm Roman. I'm the Senior E-Mobility Account Manager covering UK and Ireland for DLL. We're a wholly owned subsidiary of Rabobank, and we specialise in asset-based finance, and with a presence in over 25 countries, working closely with manufacturers, dealers and end users, offering flexible finance solutions. My goal is the same with everyone on the call, is to collaborate and really help push the transition into sustainable transport in the market.
Thanks, everyone. So as you'll all be able to see, we've got three great experts so that we'll hear really different perspectives on how residual value guarantees can potentially support their work in deployment of electric vehicles, which, as Roman said, is something that we're all very much interested in. So Amy, I'll go to you first, just to, I guess, kind of a bit of scene setting with your work at Volvo. How are you seeing customers currently buying electric trucks, and do you see this evolving more as operators start to pick up their adoption of zero emission technologies?
So currently, I mean, we offer the same finance arrangements on electric as we do for diesel. But primarily, the electric trucks that have been sold today by Volvo are on contract hire. And this is because it allows the operator to spread the costs through the lease. So then it also reduces the risk around the residual value. And it also protects the operator from potential developments in the technology that might then have an impact on the technology that they've bought today. And then could have an impact on the used market for electric HGVs. And then we also, with it being contract hire, have service and maintenance contracts included within that. So it takes away any uncertainty around the maintenance, but also a key area of concern is around battery health. It's more a perception rather than a reality, but a concern when it comes to adopting electric vehicles is around the battery and battery health. So having it on contract hire, it sort of protects the operator from these uncertainties. And this is true for new electric vehicles, but also we don't have many used trucks for sale that we've sold now, but there are the first X demos, and when you start to sell a used truck, it becomes even more important around battery health and the remaining life in that vehicle. So there's lots of uncertainties that contract hire protects the operator from. In the long term, how I see that evolving, I see the kind of similar sort of arrangements to contract hire, so a trend towards leasing vehicles or renting vehicles rather than kind of outright purchase. I think the trends in the market move towards kind of as a service models anyway, and I think the value of the batteries, performance of the batteries and potential consumption of the batteries when we get really high utilization of electric vehicles will lend themselves more to as a service models.
Thanks, Amy. That's really interesting. And I actually hand straight over to Lydia to see, as a fleet operator, does that chime with your experience and your current view of the market?
Yes, it totally aligns with that. So we have by now, or today, 146 electric trucks from Volvo, of course, in our fleet. And I think all of them are on operational lease. Some are on financial lease, but most of them on operational lease, definitely. And that is to manage risks associated with the battery lifetime or health, to manage the risk with the residual value that we cannot estimate at all at the moment after the length of the contract. So yeah, and we also see the same trend when it comes to that the new business models are developing further to the pay-per-use case. So vehicle as a service, capacity agreement, fleet capacity agreement, all of these different aspects. Yeah, I see the same.
Thank you very much. So I think it's fair to say, based on what you guys have said so far, that as we transition to these new technologies, there's definitely increasing demand for financing models that help take risk away from fleet operators, particularly with some of the uncertainty and the other challenges around adopting these new technologies. I'll go to you, Roman, now to see, does that also fit with your experience as an independent financier? And I think I'll actually also wrap up kind of two questions into one. How would you see a residual value guarantee supporting your approach as well?
Yeah, so I agree with what sort of the other people have said so far in regards to, yeah, definitely sort of we are seeing an increase in operating leases and residual value products that people are wanting to take the risk away. For us, setting a residual value is sort of the same as it has been, but we're finding different ways to value the assets. It's a complex sort of way of having to value an asset when, like Lydia said, we don't know what the cost, what the true price is going to be at the end of the term. There's been a lot of factors in there as well, with sort of the macroeconomic factors such as Brexit, COVID, geopolitical environment, changes in sort of the government as well. So there's a lot of different parts to that. With what you've explained and what you're looking to do, it would help massively, I believe, for end users, customers, to really get their TCO down and make it something that's financially beneficial to them to make the change and want to make the transition. So it's not just the end customer, it will help the manufacturer and help sort of finance companies as well by making that change with what you're proposing on this. It would really help really bring down that TCO and help, I think, sort of generate a marketplace for people to want to take EHGVs.
Fantastic, thanks, Roman. So really it's about helping you on your existing missions to support your customers as best you can and to get the maximum value out of these new assets. Amy, I'd love to actually hear your perspective as speaking from an OEM. How would you see a residual value guarantee scheme helping your work? I think you're on mute.
Kind of really building on what Roman just spoke about. The key challenge we have at the moment when it comes to deploying electric trucks is the difference in total cost of ownership with diesel. And what we need to do to address that gap is to look at multiple different mechanisms that adjust the levers within the total cost of ownership to close that gap and make it much smaller, or even get to the point where it's cheaper to move to battery electric than it is for diesel. And having a residual value guarantee, or at least the residual value element of that total cost of ownership, is one of those levers. Any sort of scheme based on residual value or residual value guarantee, it would need to offer an upside compared to where OEMs are currently setting RVs, so that risk that we've talked about, that kind of op leases protect the customer from, or the operator from, the OEMs are exposed to that, because we also don't know what the RVs are going to be in several years' time. So we're making our assumptions. But a scheme would need to offer an upside on where the OEMs are currently placing their RVs. And that would then support reducing the monthly costs, but also giving more confidence to where finance can be offered.
Thanks very much. Lydia, would you like to react to that? And I'd be interested to know as well, as a fleet operator, what would you be interested to see from a scheme like this? Obviously, what we've outlined is something that actually is kind of more targeted, at least initially, at lessors. So it's something that you're potentially indirectly benefiting from. But yeah, I'd be really interested to hear your thoughts on if you are going to participate in a scheme, what you would like to see from it.
Yeah, I feel like I'm repeating Amy here. If we look at the total cost of ownership of an e-truck, there are so many factors that we need to consider. But one of the biggest extra additional costs compared to diesel is still the lease, the delta lease price. And if this residual value guarantee program would effectively reduce this delta and lower the cost, I think that the BEV operations in many areas and locations could reach earlier cost parity during the life cycle, or over the life cycle of a truck, and that would definitely make a difference in the decision-making process for many operators to invest in an e-truck or not. And also, it would, in the end effect, lower the cost per kilometer for the operator, and that's the one factor or the one KPI that we are using to also sell that product to our customers, the end users in fact. So it has a bit of a bullwhip effect, not bullwhip, but kind of an ongoing effect. That's what we are hoping for.
Amazing. Thank you very much for that insight as well. So it's in the blueprint. We actually recommend that governments that are deploying these schemes deploy them across all different vehicle categories to make sure that that it's not leading to uneven deployment in certain areas. But it definitely sounds like you've had certain areas that you've focused on, certain use cases. So if you were recommending to a government or a financial institution looking to deploy this that had limited funds for a pilot, are there any particular use cases that you think a residual value guarantee scheme that offers a 12% discount on a lease, where would that be most effective?
You're asking me?
Yes, sorry, Lydia. Yeah, based on your current
Yeah.
operations and experience of deploying electric trucks.
I think this is a very hard question to answer, because what we experience with those electric fleet that we have now in operation is that the use cases differ so much, and they are so various across the whole operations. I wouldn't even be able to say that there is one use case where it makes more sense and the other less. I think what would be the best is if these residual value guarantee program is combined with other favorable factors. So if there is any other funding scheme, if there's any other subsidy scheme or tax regulations that are benefiting the transition to BEVs, if this whole factors are aligned, then this is where the most benefits are coming from, I assume. So in countries where you do not have access to green energy, as an example, or to any other forms of regulating the tax market, maybe they would have less of an effect at the beginning, but rather in those countries that are really tackling the green transition already.
That's really interesting. Thanks, Lydia. And I appreciate that was a very tough question. I'll go to Roman now, actually, we've only really touched, I guess, kind of on the financial structure, but obviously this is something that you and the team at DLL really were really helpful in providing feedback on, and something that we have detailed in the report. There are different structures that you can take with a guarantee, whether that's first loss or a middle slice or a bottom slice. Roman, is there which do you feel would provide you with the greatest comfort at your company, and particularly when we're thinking about how we can increase residual values that you're able to offer your clients?
Yeah, definitely. I can only speak on behalf of sort of the UK and DLL. I'm aware every European country is different, as Lydia was saying. For us, really, that I can see personally would be the top slice at the end. That's where I would see the difference. It would give us more sort of confidence and hopefully our asset managers to set a higher residual value and to be comfortable to do that, and then in turn lower the TCO for the end users or fleets. That's really the key part for us. The other two types you mentioned isn't something we do normally, but the top slice is something we would look at, and that would give comfort to the stakeholders internally when we're looking to set a residual value.
Amazing, thanks very much. And just to comment on the design of the schemes, so in the financial modelling that we've conducted and the blueprint, we provide the tools for guarantee providers to change the position of the guarantee within a particular financial structure and help understand the cost implications of changing it, because obviously if you're offering a first loss guarantee, it's much more likely to be claimed if the residual value of a truck declines and you're the first payment structure to be paying out. So all of this is something that we are looking to help governments with, and we're very keen to help provide the tools and the necessary information that governments need to be able to set a guarantee in the right place, depending on your particular jurisdiction. I will actually ask the same question to Amy. In terms of structure, is there any particular structure that you would that would be best for from your perspective? And if you've got any other thoughts to share on that, that would be great.
I haven't got thoughts on a particular structure. I'm minded to kind of agree with Roman, but I can see how other structures would work. But I think the key thing from my perspective is that a scheme needs to be as simple as possible, and it needs to support a lot of different approaches to purchasing and financing trucks. And we see this already with other incentives, where incentives favour a particular market mechanism over another. Actually, what we see is those that don't fit into that category, it sort of stalls their decision making, and it actually kind of progresses in one area but stalls another area. And so I think it has to be as open as possible and as simple as possible to support lots of different ways and ultimately achieve why we're looking at this, which is facilitate the overall transition to zero emission trucks.
Thanks very much. And as we transition now into the Q&A, we've got lots of great questions from the audience. There's actually a really interesting question that follows on from that, Amy. So I'll direct this one at you. Do you have any thoughts on buyback schemes and how they could potentially, as you were saying there, complement something like a residual value guarantee?
I don't particularly have a position, to be honest, on buyback schemes. In kind of the way I look at it in terms of supporting the overall transition, the risk is the same whether it is a buyback scheme or whether it's a residual value on a lease, really. And so a residual value guarantee should have an impact on both schemes in the same way. It really comes down to the OEM in terms of which preference they have of whether it is outright purchase with a buyback scheme or a contract hire. But I could see that a residual value guarantee would benefit both.
Great, thank you very much. I've then got another question in what is in it for financial institutions from Henrik. I think I feel like we've potentially touched on this one in that it can support finance companies with their existing missions in supporting their customers and help take away some of that risk if they are looking to support the deployment of electric trucks. But Roman, I don't know if you have anything else to add on top of that in terms of what you would see as being in it for you.
Yeah, I think you just need to look at the car market. It's probably the easiest way to look at it. You know, we don't do normal cars, and we've seen the prices of EVs going. You know, when they were first coming into the second-hand market, they were very cheap. There is uncertain what was happening in that. What this gives is some security and a tool for finance companies to be willing to take that higher RV and to pass the benefits of that across to manufacturers and across to customers. And it's kind of a collaboration in a way where, yeah, it gives us that sort of the added security to be willing to set a higher residual value and pass everything across. So we're all collaborating as one to try and get that TCO down for the end customers, really.
Amazing. Thanks very much. I think that's really clear. I think we've probably got time for one more question. So there's quite a few, but I think there's been a couple of questions around how long the scheme would run for and the annual fee contribution as well. So some of the mechanics of the scheme. So very quickly on the annual fee contribution, effectively what this is calculated as, and we break this down in the blueprint, but it's most likely going to be a cost of funds. So whatever the guarantee provider, their cost of funds is. So in the UK, for example, it'd be the cost of gilts of government borrowing, plus then the cost of administering the scheme, which based on the research that we've done, typically you'd see between 1% and 2%. And then additionally, there any kind of room for margin over the top. So you would be looking at roughly between kind of 5% and 7. And that is a percentage of the actual residual value that's being insured. So to very quickly explain that, what that means is if you have an electric truck that you're expecting to be worth £50,000 after 5 years, and you're guaranteeing that £50,000 value, you then are expecting there to be, potentially if there's a loss of say £10,000, so 20% of its value, you are charging that 5 to 7% on that 10,000. So that's how you would calculate it annually. And we've done the calculations. So the 12% cost saving that fleet operators benefit from is still very much accounts for that fee, whether or not it is passed on to fleet operators. And with that, and as a final point, in terms of how long we see a scheme needing to be in place for in order for it to provide the benefit, we would estimate that it's at least as long as the average lease period plus a few years to make sure that lessors are provided with the support they need. So in the UK, it's around 5 years. So potentially you could be looking at a scheme of 7 to 8 years, but I think it would really depend on the particular jurisdiction that you're looking at. What's worth saying, however, is that it doesn't necessarily need to be funding every single year for there to be a benefit. In fact, the improvement in residual values should happen within a couple of years, and what we would expect is that the level of support that is being provided could be ramped down. Again, very jurisdiction specific, but hopefully that gives an idea as to kind of the pathway to a fully privately funded and healthy ecosystem, which is really what designing these schemes is all about. I will wrap up the panel session there. Thank you very much, Amy, Roman, and Lydia, for your support and for all of your really insightful comments. We're really looking forward to working more closely with you guys and your companies going forwards to see if we can deploy residual value guarantee schemes. I'll now hand over to Ricardo for a call to action, and then we can finish up with comments from the European Clean Trucking Alliance. Ricardo.
Thank you very much, Tom. Very briefly, thank you for all the great questions. And I do want to say some of the questions that we haven't had time to answer are covered in the blueprint. So hopefully that will be helpful. And of course, feel free to reach out to us anytime if you want to continue the conversation. We have 2 concrete calls to action here. Anyone that's interested in continuing this conversation and supporting efforts related to implementation, please let us know. We see this as the first step in actually making this happen. And I saw a question related to implementation plans for the UK. So any government that is interested in learning more about how we can operationalize this and potentially looking at modeling for their specific countries, that's something that we would be happy to look into together. And any companies that are looking at supporting this type of programs in different geographies, also please let us know. This is something that needs to happen with collaboration from all the stakeholders. So hopefully this will help us get the process started. With that, we will drop the links to the blueprint in the chat. If you scan the QR code before, that will take you to the GFI website. We'll drop some links in the chat now. You can also find it on the Drive to Zero website, and we'll send an email with everything to all participants as well. So now to close us off, over to the European Clean Trucking Alliance.
Yes, thank you. Thank you, Ricardo, and thank you, Tom, for bringing us together today and for this great presentation on residual value guarantees. For those of you who don't know me, my name is Leila Mati, and I am the Secretariat Lead for the European Clean Trucking Alliance. As you may or may not know, the European Clean Trucking Alliance has a mission to accelerate the decarbonization of road freight transport in Europe. And our coalition brings together shippers, retailers, and transport and logistics companies who are already investing in cleaner fleets and supply chains. So for our members, the case for battery electric trucks is clear, and the transition towards zero emissions trucking is already happening. Policy and support measures are advancing, as we've discussed earlier today. Operating experience is growing, charging infrastructure as well. But most importantly, there is an appetite, and our alliance is proof of that, to drive the transition forward. But with that being said, there are still concerns about depreciation and financial risk, which can make investment decisions challenging. And in this case, residual value guarantees respond really well to this challenge by de-risking investment costs and helping to bring down the TCO. So in practical terms, this can make electric trucks more viable and a more attractive choice for fleet operators. And as some of you also may know, I know that there are some of our members in this call. In 2024, we commissioned a report also that identified residual value guarantees as a key de-risking instrument for the adoption of zero-emission trucks. So this aligns quite well with our goals. So with all this being said, the next step is to move from theory to implementation. Designing and testing these schemes will require input from all parts of the value chain and all stakeholders. And I know that our members can have an important role to play here. So that's why I'd like to take this opportunity to encourage our members to engage in the proposed task force, and to share their knowledge, their needs, their experience, and to help ensure that these mechanisms are workable in practice. I think if we can demonstrate that residual value guarantees function effectively in real-world conditions, then we can move towards broader implementation, and that would be a really tangible step forward for the decarbonization of road freight in Europe, which is what we all want. So with that, I'd like to thank GFI and CallStart once again for bringing us together and for this webinar, and for the opportunity to exchange. And I hope that we can continue working together to see how we can pilot RVG projects in the future.
Thanks so much, Leila. And equally, thank you very much to the European Clean Trucking Alliance and to Climate Group again for your support and bringing your membership together. Obviously, without speaking to the companies that are actually deploying these trucks, these schemes won't take off. So we really appreciate your support. And with that, I will wrap up the webinar for today. Thank you so much, everybody, for your time and for your engagement. As we've said already, a recording of this will be made available along with the blueprint, which you should already be able to download, and the slides as well. Thanks, everyone, for your time, and we look forward to hearing from you in the near future.
Thank you all.